Hi guys, and welcome to Freckle Finance. Today I'm going to cover the investment strategy called value investing. So this is more of a famous type of strategy than some of the other strategies that will be discussed. This is also the strategy that Warren Buffett uses. And there's many other famous investors who have used this type of strategy, and one of the reasons I'm including these in my videos, and although I don't recommend that any average person do these strategies, it's really interesting to know why these strategies work and that people do use them, so that when it's your time to come and figure out what type of strategy you're going to use, you have full knowledge of many types of strategies and you can be very confident in the one that you chose. So this type of investment strategy involves buying stocks and securities when they are undervalued and selling them once they have become overvalued. And what they mean by undervalued and overvalued is generally the stock is selling for much less than would seem reasonable based on how well the company is doing. And that would be a good time to purchase them because they are very low and they are very likely to increase. But once they have become overvalued, it's a very good time to sell because they're likely not going to continue to be overvalued even more, and they're likely going to drop. So you'd be selling them at their high point and purchasing them at a low point. This type of investment strategy definitely involves a lot of research and some assumptions. And the assumption is that when a stock is undervalued, that it will increase and become overvalued in the future. And that's not necessarily what will happen, but it's an assumption you have to make when you're doing this type of investing. As well, along the assumption line is two investors can look at the exact same stock or security and they can view it differently on whether it's undervalued or not. So this is a lot to do with your own perspective, and so that doesn't mean that it's actually undervalued just because you think it is, because someone else may not feel that way. But overall, the future will tell whether it's undervalued or not, but it is a bit of a more risky investment because of that. However, research has shown this to be a successful type of strategy, that in the long run, people can make a lot more money. But as I said, that this is a lot risky and there is a lot of research going into this. Most of the people who make a lot of money off this investment strategy do this full time. This is their jobs, to assess which stocks they should be buying and what companies they should be dealing with, etc., etc. Like, this is not something that you can really have a full-time job and then do this in your spare time. You're not going to have enough time. There are thousands of stocks out there. Part of the evaluation that you have to do is you have to assess the financial health of the company. So first of all, you have to know quite a bit about finances, and you have to feel, after you've assessed their financial health, that this company's stock doesn't make sense that it's so low because they're just so well financially healthy that this stock should be more. So you buy it with the assumption that it will increase because it's so undervalued. However, it can sometimes be hard to really know why it's being sold undervalued. Maybe it's not actually being sold undervalued and you just think it is because you don't see the whole picture, and maybe there's a better undervalued stock that you can invest in, and really it's just a lot of research and a lot of work to have to do this type of investment, which is why I don't recommend any of you do it, but it's still good to know. As well, value investing doesn't just mean that you're buying a stock because it has decreased. Sometimes stocks decrease because the company is not doing very well. And you don't want to be purchasing stocks in a company that's not doing very well because the chances of that stock increasing are not very good. They want to be buying stocks, or value investors want to be buying stocks that have no explanation whatsoever for why they're not doing well, and they seem to be really healthy financially. And that would be, with this type, there is definitely a higher chance of that company's stock going up in the future. But just because a stock has decreased does not mean that you're a value investor. That just means you're buying when it's low, and that's not always a good strategy either. As well, this kind of investment is also somewhat considered a buy and hold. Now, maybe they don't buy and hold as long as many of the buy and hold investors would, but these aren't people buying stocks in the hopes that it's overnight going to increase a lot where they can sell it. This is a longer term investment plan. They see the potential of this company is going to increase in the stock worth, but that doesn't usually happen overnight. And to some of these investors, like Warren Buffett, they see themselves as becoming part owners of the company, and Warren Buffett specifically will inject himself into the company and give good business advice on some of them and such in order to actually increase the stock. So he becomes kind of part owners of companies in order to give good business advice to increase the stocks. However, how many of us really have enough money to be able to do that? Most of us definitely don't. And most of us, the average person, is not that good at business either. So Warren Buffett is just one of those people. He just got good finance and business skills, I guess. Value stocks can be found on any stock market. There's the New York stock market and the Toronto and NASDAQ and all of them. They can be found on any of those. They can be found in any industry, but generally the value stocks are found in industries that have just recently suffered, or a company that has recently got bad media, and really overall that doesn't affect their business, but sometimes bad media makes a stock go down, which would make that stock currently undervalued because otherwise the company and the business has good potential for the future. As well, value investors have equations that they will use to figure out whether the stock is undervalued or not, and these would be involving the financial statements that you would be provided by the company and the value of the stock, and they use more than one equation, and they also have a set of rules. Like if it doesn't fall within 7% of such and such, then it's not considered a value stock to them and they won't purchase it. So there's a lot of strict guidelines that often go into what kind of stock they will purchase within a value stock. And as stated, the amount of people who truly outperform by crazy amounts, as much as 13% above the average stock market amount, these people, there's not that many of them, and these are people who do this full time, and some of them have gotten good luck in the past that they may not get in the future. So however this shows success, it doesn't necessarily show the type of success that people like Warren Buffett have made, because he's also injected himself into the companies too. But it's just important to note that although this has been seen as a successful strategy, that doesn't mean the successes are so much higher than what you would make in other types of strategies that involve a lot less work. I personally never plan on getting into this type of investment. I'm a bit of a lazy or couch potato investor, and it's just too much work for me. I don't feel like I can personally have enough of an unbiased look at these companies to truly decide what is undervalued and what isn't. If you find these videos interesting and informative and you want to learn more, please click subscribe, as I will be uploading videos every Monday, Wednesday, and Friday. Have a good day. Bye.